All right. So we're going to look at today stock dividends. Remember last time we did cash dividends, and we spoke about the 3 dates. There's the declaration date, the record date, and the payment date. And so, pardon me, I'm not going to spend a ton of time going over this again because this is fairly obvious and we did quite a few examples, but just remember you debit cash dividends, you credit dividends payable on the date when the dividends are declared. And then the record date is just when the company goes through its records to see who owns the shares, so they pay the appropriate party. And I was kind of jokingly telling you, I mean, it's true, but jokingly telling you about like the few pennies of Apple dividends that I get from time to time, because they're checking to make sure that I'm actually the owner of the shares, and then they pay me out. In this case, it's in the Robinhood account. And then the payment date is when the company actually pays the dividend. So you debit the liability because the liability goes down, and you credit cash. And some of the key takeaways, again, that we're not entitled to dividends as stockholders. We are only entitled to receiving a dividend when it's declared, not just because the company is profitable. So companies like Apple and others for years didn't declare any dividends, and there was nothing that the stockholders could do. Also, the company needs to have adequate cash in order to declare cash dividends so that they can actually pay it. And the dividends are always paid out of retained earnings, because retained earnings is the profit that the company's made over time, that they've kept back, that they have not distributed to owners. And as they make distributions to owners, there's less and less profit in the company for owners to receive in the future. So the dividend comes out of retained earnings. And then we spend some time, sorry, I don't know why it's so difficult for me to get to this. We spend some time talking about allocating the dividend between preferred and common stock. And we spoke about how the preferred stockholders have the rights that, again, are higher than common stockholders. So they will receive dividends before common stockholders, regardless of what amount of dividend is declared. Preferred stockholders will always get theirs first. So sometimes stockholders don't get anything because sometimes common stockholders don't get anything because preferred stockholders have to be paid and there's not enough money to go around. And then other times, and we saw this when we were doing this example, this example 4, you saw that other times the common stockholders could get, a whole heap of money, because it just depends on what total dividend was declared. And we also saw that because the preferred dividend is expressed as a percentage of par, there's actually a way to calculate the annual preferred stock dividend, which is the number of shares. I mean, this can be in any order, right? Because we're multiplying. But in this case, we said it's the number of shares times the dividend percentage times the par value. So we know that each year they have this dollar amount that is their annual dividend, and whether it's cumulative or non-cumulative is told to you in a question. And already cumulative means that if we didn't pay them the dividend, the entire dividend in the current year, next year we have to pay them whatever is in arrears from this year, and we have to pay them next year's dividend as well. And so if we're not declaring enough dividend to cover all of this, the arrears just keeps growing. But again, that arrears, like here we saw there was a 2,000 arrears, that arrears will always be paid first before anything else is paid, and definitely before common stock is paid. So that was the allocation, right? We went over that last week on Thursday, the allocation of dividends between preferred and common stock when the dividend was cumulative. I also gave you an extra example. If the dividend, I said, what if the dividend was non-cumulative? And you guys told me that if it's non-cumulative, previous year's dividends that have not been paid are ignored, because it's kind of like, you either receive it or you don't. Non-cumulative means that arrears dividends do not accumulate over time. And this isn't, us robbing the preferred stockholders or something. Remember, the preferred stockholders agreed to all of these terms, at the time when the stock was issued. So this isn't a matter of, suddenly people are being, shortchanged or something like that. They know that this is what they agreed to. So this topic, which we spent an extended amount of time on last week, and I did post the video and so on, is something that people often struggle with for whatever reason in practice. I think the reason is that there are so many things that you have to take care of in order to figure out the split. You have to take care of or consider the dividend percentage for preferred stockholders. You need to know how to calculate that annual dividend. It's all stuff I showed you here in these workings. You need to know how to calculate the annual dividend. You need to know whether the preferred stock is cumulative or non-cumulative, so that you know whether it's adding up or not. You also need to understand that the company will declare a dividend amount that could be completely different from the annual dividend that the preferred stockholders are supposed to get. And that total dividend amount is what's split between preferred stock and common stock. And you need to remember that preferred stockholders will always get paid first, and that common stockholders get kind of the residual, right? They have a residual interest or leftovers, if you want to call it that. So I think that and obviously also the notion that the circumstances could change. It could be a cumulative preferred stock or non-cumulative. So I think part of why people struggle sometimes with this question in the homework, and they've also struggled with it on the test in the past, and it will be on the test, and it is in the homework, is that there are many rules and things that you basically have to have in your mind as you go through. It's not just a simple calculation that you can just memorize and you're done. So please take time to read through and make sure that you know how to do this, because like I said, in general, when we have the test, this is one of the questions where the most points are lost. And I think it's just a matter of, you have to know the theory behind this and understand the rules for how to calculate the split between preferred and common. And you actually have to practice, right? You have to do the homework and so on, and make sure that you are able to get the splits right. Okay, so that was last time. And then I said, we're moving into stock dividends next. So cash dividends done. Stock dividends, as the name implies, you're getting stock instead of cash. Sorry, I didn't see someone was in the chat. Can we do a one-day review for exam? It depends on how much time we have before the exam. I'm reviewing as I go. I'm reviewing the homework with you guys on Thursday. When you're done with the chapter 14 homework, I'll review that. I'll go over the prep sheet with you. So I'm not into a crash course, let's cram it all in type review, because it's overwhelming. I'm hoping that people are doing the work as we go along, and that I can actually sort out any issues people have with their understanding in the moment, as opposed to waiting till the end and then people are cramming for the exam. So I'll see how much time is available. We might have some flexibility in the schedule. I'm happy to do a review, but I guess I want to make sure that people aren't banking on like, oh, I'll just wait until this magical day when we do the review and then I'll understand everything, because you need to try. And I know that's not what you meant when you asked that question, but I just want to make sure that people understand that you need to be figuring the stuff out as you go along, and being able to do the work anyway. I'll try and help you however I can. I also have office hours if people need to review concepts. You're welcome to join that as well. So let me see how we go along, and if I can squeeze out some time before the test, I'll try to do that. We may be a little bit ahead here. All right. So a stock dividend, we're giving out stocks. It's also pro rata, just like how a cash dividend was. So pro rata for cash dividend meant that if the company declares a $1 cash dividend per share, and I have 3 shares, then I'm getting $3, right? That's how that works. With the pro rata distribution with the stock dividend, it's kind of the same thing. You're getting stocks in the same proportion to, you're getting new stocks in the same proportion to the stocks that you already own. It's just that the stock dividend is expressed as a percentage. It's not, it obviously can't be expressed as a dollar amount because it's not a cash dividend. It's going to be expressed as a percentage. So it's, obviously also decrease in retained earnings from a stock dividend, because you're distributing in this case, not money, but stocks to the owners, the shareholders. So, in the end, it's like we're issuing common stock, but you can't have a one-sided journal entry. So you credit common stock, but you have to debit something. And, it's obviously not a debit to cash. You're not receiving cash, but what you are doing is you're taking money, right? You're getting rid of some of your retained earnings in order to make that distribution. So you're basically just shifting things around in your stockholders equity section of the balance sheet. This doesn't involve cash at all, right? Why issue stock dividend? Like I said, I don't think this page number is accurate, but I'll show you here in the textbook. Let me get rid of this. So, there are reasons here for why to issue stock dividends. And sometimes it's because, the investors, and I kind of alluded to this on Thursday. I mean, in its, I guess, least, I don't know, strategic, or I don't know, maybe it is strategic, but I think least strategic way, it's like if a company was always paying dividends, right? They were paying cash dividends, but they don't have the cash to pay a dividend this time around, they may issue a stock dividend in order to just appease the investors, to like just give them something and not cause a massive dip in the stock price, because there's normally a bit of a freak out if a company always paid dividends and they suddenly don't, because it's an indicator that something is up with their profitability and with their cash situation. So they may pay it just to satisfy the stockholders. Increasing the marketability of the company's stock, because a stock dividend increases the number of shares out in the market. So the market, so supply is increasing. So if you just think of, very basic economics, when the supply of something increases, it's likely that the price is going to fall. So they're saying, then when the price falls, maybe more people would be open to investing in the company. And then, the other piece is to kind of say, well, we're shifting out of retained earnings. We're taking some of our profits out of retained earnings and putting it into stock. So it's like what the book says is that the people are permanently reinvesting in the business. They're not expecting to get that distribution in cash. Okay, so those are some of the reasons why a company would do a stock dividend. And then, like I said, the stock dividend is expressed as a percentage of the number, this is important, a percentage of the number of shares outstanding, okay, outstanding. So this then means that on the day when the stock dividend is declared, you should be trying to figure out what is the number of shares outstanding on that day, and then the stock dividend will be a percentage of that number. I know this all sounds very basic, but trust me, people mess this up all the time, okay? You're not looking at the number of shares outstanding at the beginning of the year. You're not looking at the number of shares outstanding last month. You're looking at the number of shares outstanding today, on the day that we are declaring the stock dividend. And why I'm being so specific about that is it's possible that companies could actually be issuing shares, in the time from the beginning of the year until the stock dividend is declared. So you have to take all the shares that were outstanding at the beginning of the year, plus any additional stock issuances you have to take into consideration to get to the number of shares outstanding. And I'll show you in an example. And then stock dividends are either called a small stock dividend or a large stock dividend. Small stock dividends are somewhere between anything up to 20 to 25% of the number of shares outstanding, and large stock dividends are over 25%. We will only look at small stock dividends. A large stock dividend is kind of a different animal, because it's there's something more going on than just paying people, regular folks, the stock dividend. So we'll look at small stock dividends. So you can expect percentages to be somewhere, up to 20, 25%. And here's an important point that, again, I want to, underline and highlight and so on. The value assigned to the dividend, because remember, up to now, we've only been talking about the number of shares is some percentage of outstanding shares, but you obviously can't journalize a number of shares. You have to actually have a dollar amount to journalize. So then the question is, what are we going to record that number of shares at, right? What's the dollar amount that we're going to use? And so that becomes the fair market value of the shares, which kind of makes sense, because what you're saying is you're issuing dividends to someone in the form of a stock. And if this person's like, oh, I didn't want stocks, I wanted money, what they can do is literally just turn around and sell the share to someone else, and they can get money. So fair market value makes sense, because they would be selling, what are the shares worth, whatever you can sell them for on the market right now. Okay, so when we do the journal entries, we're looking at what's the percentage stock dividend, what's the number of shares outstanding, what's the fair market value of the shares on the date of the stock dividend. Those are the things that are driving the journal entry that we need to make. Does anybody have questions for me at this time about the theory behind stock dividend before we hit the way the journal entries look? Okay. So here we go. We have the same dates that we're talking about with cash dividends. There's a declaration date, there's a record date. In the case of stock dividends, we don't really call it a payment date because there isn't an actual payment that's being made. It's called an issue date because you're issuing stock, okay? You've heard that word before of issuing stock because we did it all the time in chapter 13. So at the declaration date is when the board of directors will say we're issuing a stock dividend, let's say 10% stock dividend on the outstanding shares today. In the book, you will use the word stock dividends as the account, just like we used cash dividends. I did put retained earnings here to just remind us all that ultimately, right, retained earnings is going down because the stock dividend account will be closed out. It's a temporary account, okay, that gets closed out to retained earnings. Later on in this chapter where we do some retained earnings calculations, you'll see that stock dividends and cash dividends decrease retained earnings, right, which makes sense because we are distributing some of the earnings that we previously held in the company. So stock dividends is the debit, and it's going to be for the number of shares in the stock dividend, okay? So not the number of shares outstanding, the number of shares in the stock dividend is what you're using, multiplied by the market price, which is the same as fair market value of the shares. So that's the actual, dollar amount, the value of the dividend is what you debit to stock dividends. And now we have some differences here from, dividends payable, remember, was the thing that we used for cash dividends. In stock dividends, because you're not actually going to pay off a liability, you actually have to use some type of equity account, but you can't use common stock at this time because you have not yet issued the shares. So you use an account that is going to stand in place of common stock to show the readers of the financials that they are still shares to be issued. And the name of that account is Common Stock Dividends Distributable. Okay, so I repeat, we are going to issue shares, okay? But today, the declaration date is not the date of the issuance. It's coming later on when we'll actually credit common stock. So because just like how we couldn't use cash for cash dividends, we couldn't credit cash on the declaration date because we still owed the money. So we use dividends payable, right? Yeah, we can't credit common stock because we haven't issued the shares. So we have to use this account, which is also an equity account, but it's kind of a placeholder that we keep this amount in until we issue the shares. So the name of that account is Common Stock Dividends Distributable, and it's got the same type of formula like what you use for common stock. It's the number of shares, and yeah, I should have written in the stock dividends, right? That's what you're using. Number of shares in the stock, in the stock dividend multiplied by the par or stated depending on what's happening, there could be a par or stated value. This is getting really long. Let me see how I can fix my life here. Or maybe this is not the time to, oh, let me just open this. All right, so number of shares in the stock dividend multiplied by the par or stated value is what is going to go into common stock dividends distributable. And then I always write APIC, which is, my my knee jerk, but we'll use the long-winded name that the book has, paid in capital in excess of, I don't know, it's going to be par or stated value depending on what the company is using. Common stock. Okay, that's the other part of the credit. So it's almost like the two accounts that you credit when you do an issuance of shares, except that you are using common stock dividends distributable. Okay, that's a different account. A different name than what we've seen before. And like I said, common stock dividends distributable is a stockholders equity account, and it's also shown as part of paid in capital in the balance sheet. So if our year ended now or our quarter ended and we had to make a balance sheet, we would actually put common stock dividends distributable into stockholders equity. Questions on this journal entry? This is the hardest part of the stock dividends work, because you have to figure out how many shares are on the dividend, you have to figure out the market price, you have to remember that this account is being used, but it's not common stock yet. And then you also have to calculate the paid in capital in excess of par, which is going to be the difference between these two numbers. Anybody want me to go over anything again or whatever? I'm happy to do whatever you need.
Nah, I think I'm good. I think I'm just ready to see like some examples of how it's done.
Good. Okay.
Get a better grasp.
I'm ready to do examples in a minute here as well. So the record date, same deal as, okay, hang on, someone's talking to me in the chat. That should be it. That should be it. Okay. Record date, same deal as cash dividends. They're just going through the records to see who owns the stock so that they issue the stock dividend to the correct investor. And then when it comes to the issue date, what ends up happening is you get rid of this account, common stock dividend distributable, because you don't need it anymore because you're about to distribute the actual stock. So you debit common stock dividend distributable, and then you credit common stock. And this credit to common stock increases the common stock account, which is what you want because you're showing that the investors, invested in the company by virtue of the stock dividend. So the ultimate result of a stock dividend is that you're just transferring a piece of retained earnings into common stock and paid in capital in excess of par or stated value, which together make up paid in capital. So you're moving things from earned capital into paid in capital. It's just a stockholders equity shuffle. All right, so we'll go ahead and do example 5 to see if we know what on earth just happened, right? See if we can put our knowledge through this. So I'll work it through with you, and then for number 6, I will I'll show you. I'll work 5 through with you. I'm blanking out. I'll work 5 through with you, and number 6 you will do on your own. So please don't blank out like I just did for a second there. You need to know how to do it because you'll be called upon to do number 6. So in number 5, on December the 31st, 2018, Medland Corporation has a balance of $300,000 in retained earnings. Okay, so they're telling you there are some retained earnings available, for a dividend. It declares a 10%. So there you can see, right, the dividend percentage is a small stock dividend. So it means that we have to use the fair market value of the share as the amount at which we will record the dividend. It's a 10% stock dividend on its 50,000 shares. Okay, so it's a fairly simplistic example because they're telling you the number of shares outstanding. You don't have to add anything together, whatever. It's 50,000 shares of $10 par value common stock. So the $10 par value is not going to be impacted by the 10%. The par value is the same. You're concerned with 10% of 50,000 shares. That's going to be the number of shares issued in the stock dividend, which is going to be the answer to the first question. The current fair value of its stock is $15 per share. You need that information because, like I said before, this is a small stock dividend, so you record it at the fair market value of the shares. Medland issues the shares on January the 2nd, 2019. So they're issuing it the next year, which means that the common stock dividend distributable account is still floating around at the end of the year. Okay, so let's see how what we're called upon to do here. How many shares are issued in the stock dividend? The journal entry for the dividend declaration. Prepare the stockholders equity section at December 31 after the dividend declaration. So that's to show how common stock dividend distributable is shown in the financials, and then prepare the journal entry for the issuance of the stock, right, on January the 2nd. So example 5. And again, I know I've said this multiple times, but it bears repeating that everybody has access to this document that I'm working on. It's the link to the Google Doc is pasted on Blackboard under Zoom materials. So I think I'm probably being too quick to do that. So let's first just calculate the number of shares in the stock dividend. Okay, number of shares in the stock dividend. So the formula is number of shares outstanding on the dividend declaration date multiplied by the stock dividend percentage. Okay, I'm writing it out here so that you'll remember how to do it. So the number of shares outstanding was 50,000 per the question. Right, the stock dividend percentage is 10%. So it must then be that there are 5,000 shares in the stock dividend. And that's the number that you work with, not the 50,000. Okay, you need to be not 55,000 either. You're working with just the percentage of the number of shares outstanding. The 5,000 is what you should be focusing on. Okay, so this number will drive our calculations from here on out, 5,000. Prepare the journal entry for the dividend declaration. So this is where we need our debits and credits. All right. And this is also where you'll now use the stock dividend account and all of that. So you're going to debit stock dividend, and you're going to debit it with the number of shares in the stock dividend multiplied by, what did it say in the theory, right? Number of shares in the stock dividend multiplied by the market price of the shares. And in the question, they tell you that the fair value, which is the same as the market price, is $15. Okay, so it's 5,000 shares times $15 per share. Okay, that's the amount at which the stock dividend is recorded. So 75,000. And then the common stock dividend distributable is going to also be the number of shares in the stock dividend, but it's not going to be multiplied by the market price. Remember, in the theory, we said it's times the par or stated value. So when you go back, you remember that there was a $10 par value. So that's what you're going to use in the calculation. So it's 5,000 shares times 10. Oh, sorry. So this is going to be 50,000. And then your paid in capital in excess of par value. Remember, I told you can just use the difference between the other two numbers. I mean, it's also just going to be 5,000 times 5, right? That's the excess. So paid in capital in excess of par value, common stock. And yeah, it's obviously 25,000, which is just also the same as 5,000 shares times 15 minus 10. Either way, as long as you make your journal entry balance, you're probably going to end up with the correct amount in paid in capital in excess of par value. Questions, anybody? Because this is for the people who were saying they needed to see this in action. This is, this is the translation of all that theory into an actual example. Yeah. Anybody need me to discuss anything? Okay, so where do I see errors normally is, people don't actually calculate the number of shares in the stock dividend. They just go with 50,000 sometimes for whatever reason. People calculate the 5,000 shares, but then they fall down on using, using $15 for stock dividends and the par value or stated value for common stock dividend distributable. So then that ends up being wrong. I also see people put common stock here instead of common stock dividend distributable. That's incorrect. So there's a few ways that people get confused on these questions. So just make sure that you have those clear, in your mind. Sorry, why we're doing things the way we are. All right, so then in part 3, it says prepare the stockholders equity section of the balance sheet following the dividend declaration. So this is where I show you how common stock dividend distributable looks in the balance sheet. So it's the name of the company, Midland Corporation. It's a balance sheet. It's a partial balance sheet. You don't have to write partial, but sometimes the book does it, which is why I'm doing it. December 31, 2018 is the date of the dividend declaration. There you can put, liabilities and stockholders equity to remind you that the overall, part of the balance sheet that this belongs to. But I think most of the time Wiley doesn't bother with that, but it's fine. I'm just reminding you that this is that section of the balance sheet. So now we're being asked to do stockholders equity, which is what I'll go into now. Remember, as I said before, you don't have to memorize all these headings and so on. You can use, I think it was illustration 1311 as a guide when you're doing a balance sheet. So don't try to memorize everything, but make sure you know which numbers go where. Okay, I'm saying don't memorize all these headings if you don't have to. So paid in capital is the next subheading, and then you've got, then you've got capital stock. We don't have preferred stock, so we don't have to put that down. We do have, wrong way. We do have common stock. We've got 50,000 shares at $10 par value. So that means the common stock is 500,000. So common stock, right? 50,000 shares, $10 par value. I'm just writing it in here so you can know where the number came from. So that's going to be 500,000 is our common stock number. Then the common stock dividend distributable balance that we created over here is part of capital stock, okay? Because eventually it's going to become common stock. So I put my common stock dividend distributable account over here, and it's 50,000, okay? And the nature is that it's part of the capital stock. And so now I can, put a sum for that, and obviously it's 550,000, and this is total capital stock. And we do have additional paid in capital because we just created the balance over here for 25,000. Remember, in this case, I did the journal, but I skipped the ledger step, and I'm going straight into the balance sheet. But I can see the numbers over here because these are the only numbers we have in the question. It doesn't say anything about a beginning balance in additional paid in capital. So it must be that the 25,000 is the only number that we have to work with. So, additional paid. Okay. So then this is in excess of par. common stock. And we take the 25,000 from the journal entry. And so then that's the end of paid in capital. So it's total paid in capital is going to be 575,000. Again, remember that the whole purpose of doing this, what's new in this is this piece. Okay. That's why they're asking us to create this balance sheet to make sure that we understand that common stock dividend distributable is part of stockholders' equity. It's also, goes as part of the capital stock, because it's basically going to become common stock on the issue date. And then we were asked about retained earnings also. Well, not asked, but I mean, we have to keep track of retained earnings. Retained earnings has a balance of 300,000. So now is the opportunity where you can see the impact of a dividend on retained earnings, because remember I told you that the stock dividend account gets closed off to retained earnings. So you see there's 75,000 in that account. So I'm going to write over here on the side, right? The stock dividend account would be closed off to retained earnings before the balance sheet is created. So retained earnings decreases by the amount in stock dividends. So I'll show you what that looks like. This is supposed to be the actual account name. Right, I'm not going to get too crazy. So retained earnings had a balance of 300,000. That's what we were told in the question. But since stock dividends are paid out of retained earnings and we close off the stock dividend account to retained earnings, we have to subtract the 75,000 of the dividend amount over here. And that makes sense because remember, we took 75,000 out of retained earnings and we put 75,000 into paid in capital, this 50,000 and the 25,000. So in the end, nothing should have changed in terms of the final balance on stockholders' equity. Nothing should have changed. So retained earnings is 225,000, and so this is total stockholders equity, that is 800,000, right? These two numbers together. So this is after the declaration. If you're confused and you're like, I don't understand why I had to deduct this from retained earnings, remember that before everything in stockholders equity still has to add up to 800,000, okay? Before this thing happened, it was also 800,000 because you had 300,000 in retained earnings, 500,000 in common stock. So it was 800,000. After you took 75,000 out of retained earnings via the stock dividend and put 50,000 into common stock dividend distributable and 25,000 into paid in capital in excess of par value. So that shows you that a stock dividend really amounts to taking some chunk of money out of retained earnings and putting it, so earned capital, and putting it into paid in capital. But the final balance on the stockholders' equity, the final balance on stockholders' equity stays the same before and after the stock dividend, right? Because a stock dividend is just moving money from earned capital, which is retained earnings, to paid in capital. All right, that's the, that's what it amounts to. You're just shifting stuff around, which is why, like I said, sometimes when companies don't have cash, they'll do a stock dividend because they're just shifting things around. It doesn't really change their balance sheet overall, it doesn't change. Questions, anybody, before we show what the issuance of the stock looks like?
I have a small question.
Mhm.
In the stockholders equity statement that you did, it's the same example as in the book, but in the book they show the additional paid in capital just as the paid in capital, like they don't write the extra line, and then they do total capital stock or total paid in.
Oh, okay. Yeah, I think you can, let me make sure I understand what you're saying, because I think you,
It just made it
yeah,
shorter.
that's a shortcut. I mean, I don't know what the system will allow. I think they're just trying to show you how this can be done. I mean, theoretically, additional paid in capital and capital stock should be split. I don't know why they're doing it like this, other than maybe just trying to show that, I mean, paid in capital in excess of par is part of paid in capital, but it's not technically part of capital stock. So I think they're doing it like this because they didn't use the capital stock subheading. I mean, this is getting really like in the weeds, right? You see how this just says paid in capital? It doesn't have capital stock as another heading. So if I didn't have capital stock here, I could just throw everything together. But I'm doing the, I guess, the 100% accurate way of writing this out.
Okay, so for the homework and the exam, we'll need to do it the same way as you do it, right?
You have to if we were doing manually by hand, I would just give you the template. Unfortunately, I don't like that there's an inconsistency here, because how you do it will depend on what the Wiley system gives you.
Yeah, I feel like
remember there was all that mess with when they only asked for paid in capital and not stockholders equity. So yeah, it depends on what they give you.
I feel like it's getting so confusing with the stockholders equity because each one is a little tiny change.
Yeah,
that
I don't think you should let's not get too bogged down. Let's come up with a rule, right? If they're only doing paid in capital and not splitting out capital stock, then the excess will go with common stock. Okay. So if this heading is not being given in your Wiley, if they don't say capital stock, then they're probably expecting that you just combine everything in one. If they are splitting capital stock, then my expectation would be that, let me show you here. Then my expectation would be that you show the common stock and the preferred stock first. Oh great, now I've been thrown out of, I'm just gonna go back in here. It's hard because I even contacted the Wiley rep the other day to say that there was an error in the system. I mean, I don't think that the book is showing an error. I think they're just skipping a step, which is fine, but I can't guarantee. I can look at the question and tell you guys before the test, but I can't guarantee that there will never be glitches. So if you look at this 1311, right, you see how it says paid in capital stock. And so you total the capital. So this is like the perfect balance sheet, which was also what I was doing. But if you don't see this as an option in the question that you're doing, and they just say paid in capital, what they're doing then is that they're just going to combine common stock and paid in capital in excess of par together. Okay, so you'll have to just make a game time decision to see what headings they're giving. Like I said, I can audit the questions before the test to tell you guys what they want from you. I'm happy to do that. Just remind me. Okay.
Okay, thank you.
No problem. Anything else?
No.
Well, in general, anything else that I need to explain here? Okay, so think, if there's anything else, let me just finish with part 4, which is going to be just the issuance of the stock, right? Prepare the journal entry required on January the 2nd. So it's going to be, remember we created this common stock dividends distributable account here to kind of hold the amount until we issue the stock. So we credited to increase the account to 50,000. So now we have to debit that same account to get rid of it, right? So it's common stock dividend distributable, right? The longest account name ever. 50,000, and the credit goes to common stock because now we are actually issuing the shares. And so ultimately what happens is the common stock dividend distributable account is zeroed out. It goes down to 0. And in the stockholders equity, so this thing that was over here, right? It gets zeroed out, so it doesn't exist anymore. Common stock will become 550,000 and everything else stays the same. But common stock dividend distributable now becomes, so this is on January 2, if you had to just make a quick balance sheet at that point, that's what it would look like. But notice how you still end up, right? You still end up in the same place. This is still 550, right? This is still going to be 225. So this is still going to be 25. I'm not doing all the intervening totaling. So you're still going to end up with 800,000. You're just shifting things around again. So what's the journal entry? Debit common stock dividend distributable and credit common stock. Questions, anybody, about any part of this example? All right, so let's take 10 minutes here. People can think about whether they have other questions for me. We'll come back at 11:51. I'm gonna let the, I don't want to ever have that issue again where I forget to press record. So I'm just gonna let the recording run during the break. But you guys are welcome to chat to me if you have stuff you want to talk to me during the break. Michelle, yes.
I know I emailed you about one of the homework questions for number 6, and
Yeah,
I know you emailed me back, but
Mhm.
I'm still kind of confused.
Can you want to share?
So for some reason I can't get Wiley Plus on my iPad, but I can share like the email.
Then I'll just, why don't I just share, if you're comfortable with it, I'll share my screen that's actually showing your question. Is that okay?
Yeah.
Okay.
Yeah. That's it.
Professor,
Yes, hello.
you said 10 minutes, right?
Yeah, 11:51.
Okay, if I leave the Zoom meeting right now and come back at 8:51, will I still be counted for attendance?
Absolutely, you're here. I've now encountered you for at least an hour, so you're good.
Okay,
Yes.
I'll be right back because I'm using my
Okay.
phone for the class
Now I
right now.
understand it's a lot for your phone to deal with. Okay,
Yes. Okay, thank you, brother. I'll be right back.
no worries. Michelle, you can see what I'm
Yeah.
doing here, right? Okay.
Mhm.
Okay, so when
Oh,
I
no,
email,
for number 6.
oh, I thought you were talking about number 7. Sorry, I don't think I responded anything about number 6 because number 7 was what you
Yeah,
asked me about.
I realized I was trying to connect the numbers. I was like, wait a minute.
But your number 7 was also wrong.
Yeah, I haven't. I was gonna. I got
Okay,
tired of
no,
it.
that's
So
fine. I'm sorry, I completely didn't answer your question then. When the thing that you sent me, I thought was the part C of number 7. So I went off on a tangent, sorry. Gotcha. Okay, let's see what's popping here.
yeah. So for
Yeah,
like
let me
the
see.
2, I think it's the 3 boxes that is
Mhm.
marked as the red part.
Yeah.
I wasn't sure.
So total paid in capital is not just the 1230. It's the capital. It's this. It's the 2592
okay, that
plus
makes
the
sense.
right.
That
You have
makes
to add in every. This is
Both
what we're
of
just
them.
talking about now. These confusing line items, right? So paid in capital is capital stock and additional paid in capital.
Okay.
Okay, so
Okay.
that's the issue there. So that's just a
Okay.
math. And then And then once you change that number, the total paid in capital and retained
Right,
earnings
it's
will
gonna
also
change.
change.
Right,
right?
and then it follows through.
And then the
Yeah.
total should also change. So why don't
Okay.
you, I don't know if you can fix that now and we can confirm that it's working out, but that's what should
Yeah,
happen.
I could log on to my laptop.
Okay.
Okay. Oh no, my calculator. I'm just waiting for it to.
Yeah, take
Come
your time. I'm actually just gonna step away for a second, all right?
Okay. Okay, I'm here.
I'm back if you need to ask me something, sorry.
That's okay.
Okay.
I am plugging it all in right
Okay.
now. Yeah. Okay. Wait, I have to do this over. Um, hmm. Okay. Okay, I fix it.
Okay, cool.
Yeah.
Great. Sorry for the misunderstanding and then the
That's
subsequent
okay.
tangent.
It's okay.
Hopefully it helps you to answer question 7. It's the dangers of answering emails at like 11 o'clock at night or whatever
No,
time it is.
it was also me because I
No
have
worries.
this thing where I do my homework pretty late, which doesn't
Mhm.
help the fact that it makes you even more stressed out. So
Yeah. I mean, you know it. We all
yeah.
know it. And then I have the thing where as soon as I see an email coming in at
Mhm.
night, if I already know my morning's gonna be busy, then I try to answer it immediately. But
As
that
yeah.
also opens you up to not reading things properly and whatnot. Anyway, human nature, right?
Yeah.
Okay, cool. I'm glad that's resolved.
Thank you.
No worries. Okay, so we're back. I was just finishing up the making sure that I have everybody's attendance. So I'm only calling out names of people that I don't think I've seen throughout this first hour or so of class. Is Naili here? Naili, are you here? How about Christina Medrano? Shafak? No. And that's it. Okay. Everybody else is here. All right. So don't worry.
All right, I was just about to say I didn't hear my name.
No, I'm only calling, I don't want to call everybody because I can see you guys. So I'm just calling people that I haven't seen since the start of the class to make sure that they are actually truly absent. Yeah, you're good. I've got you, Andrew. Guys, so number 6 will be for your consideration and to do the journal entries yourself. I'll read it with you and then you can take some time to answer the question and then we'll see if everybody is okay with how it goes. So Langley Corporation has 50,000 shares of $10 par value common stock outstanding. It declares a 15% stock dividend on December the 1st when the market price per share is $16. The dividend shares are issued on December 31st. Prepare the entries for declaration and payment or issuance of the stock dividend. So I'm going to give you until noon, until 12 o'clock, so about 6 minutes to do the journal entries, and then someone can walk us through their answer. All right, so number 6 is what you're doing. And I'll give you a few seconds if you need to take a picture of the question. If you don't have this open, take the picture of the question so that I can go back to the previous answer so that people can maybe use that as a guide for how to answer this question. Okay, so hopefully you took a picture of this question now already, number 6, and I'll go to the solution. I'll just leave it here. So you can use number 5 as guidance on how to answer number 6. You have until 12 o'clock. Hi, Natasha. Yes, I marked you present. I know you were
I'm back,
here.
Professor.
Yeah, okay, good. You're doing number 6, John. I'll just flip. This is the question. I don't know if you have it on your phone or take a picture or something. I don't know if you'll be able to do that if you're using your phone, but you're doing this question, number 6. I see your hand. I'll take you, see when time comes, okay? All right. So that went hopefully not too quickly. If you're still scrambling to get to the answer, that's okay. Just keep going. I have C. I see you are there first, so I'll take your solution. And Scarland, I see your hand. I can take you for another example. Or C, you put your hand down. Okay. So,
No,
oh, you're gonna talk. Okay. So, okay. So, what do you want to tell me? Go for
So
it.
I calculated the shares to be issued first. So I
Okay.
did 1,000 by 15.
So,
by-
number of shares in the stock dividend. That's where we start, right? So you said 50,000 times 15. Okay. So
Sorry.
it's I know this is very boring, but I just for those who are still, following, trying to figure things out. Number of shares outstanding multiplied by the stock dividend percentage. And you said 50,000 by 15. And how many shares did that give you?
7,500.
7,500 shares, so 15%. Oops. 15%, 7,500 shares. Thank you. What do we do now?
Then I put aside that the par value is $10 and the
Mhm.
market price is 16. Just so it will be easier to answer.
Yeah, so you don't have to keep going back to the question to find information and potentially even pick up the wrong thing. Absolutely. Go on.
Okay. And then I started doing the declaration date
Mhm.
as an entry, and then I did stock dividend. I debited by 75 by 16, which is 120,000.
This is the number of shares times the market price. Yes, which is 7,500 shares times $16 per share. Did you get also 120,000, right?
Yes.
Mm-hmm.
Then I credit common stock dividend distributable.
The long name, common stock dividend. I'm gonna do that because I'm gonna run out of space. This is gonna be the number of shares times the par value. Good. So tell me what that comes to.
75,000.
7,500 times 10, right? So I'm just gonna do this for those who are really struggling to keep up for whatever reason, and this is 7,500 times 16. Thank you. What's next?
And then I credit paid in capital in excess of par common stock. I do 120,000 minus 75,000, which comes out to 45,000.
This is 120 minus 75. Good. Yes, that's the declaration date journal entry. All right, so again, first start out by actually calculating the number of shares in the stock dividend. Be smart here, like C's doing, maybe keep track of your par value or stated value, keep track of your market price. Know that it's the number of shares times the market price that goes against the stock dividend amount. That's the actual dividend amount. And then the common stock dividend distributable is the same formula like what we would use for actual common stock. It's the number of shares times the par or stated value. In this case, it's par value. And then the paid in capital in excess is the usual, where it's like a plug number. You just subtract what's on the debit minus what's on the credit and get to the difference. Or if you really want to know how it's calculated, it's the $6. That's the difference between 16 and 10 multiplied by 7,500, right? It's the excess. And what did you do? When was the payment date? December 31st? Okay.
Yeah, I forgot the
Issue
date.
date. Issue date. Yeah, that's fine. That's December. Mhm.
The issue date, I debit common stock dividend distributable by 75,000.
So you're literally just pulling the number from the previous journal entry. We don't have to do any work. We're zeroing out that account, and where does the credit go?
Common stock.
Mhm. All right. That is correct. Okay, so notice for those who are still thinking about this, that the process, the numbers are different, but the process that we did in 5 is the same process as 6, right? The way the calculations flow. So what you need to do is remember or memorize or understand, however you'll be able to do it, the rules of how to calculate this, and then you're just practicing to make sure that you remember the account names and so on. Okay, so that's stock dividends. That's the end of the examples that we have for stock dividends. Does anybody have anything else that they want me to explain or go over again or clarify before I move into stock splits with you? Okay. So that was example 6. So we're shifting gears now, like I said, right? We're shifting over to a new topic. Sorry, this thing, I don't know what's happening. To stock splits. This is a tiny topic in our work, but it is still an important topic. So I'm not going to just ignore it, but I'll just talk you through it. There isn't really a formal example for this because it's such a small topic, but I'll show you how this also applies in quote unquote real life, right? So we did cash dividends, we did stock dividends, those topics are done. This is a stock split. This is not a dividend anymore. This is when a company decides to split its stocks that are already out there, that are already outstanding in the public. So a stock split involves the issuance of additional shares to stockholders according to their percentage ownership, all right? A stock split also results in an increase in the number of shares outstanding and a decrease in the par or stated value per share. So the increase and decrease is proportional. So what does that mean, right? So we could say that we're going to do a 2-for-1 stock split. So let's say I own 1 share in this company. What's going to end up happening after the stock split is that instead of owning 1 share, I will now own 2. So now you should be feeling like this is weird because you're like, are people just getting stuff for free now, right? Because that's kind of what it feels like. Like, hey, you had 1 share, great, good times, here's another share for free. But that's not how it works, okay? How it really works is that, and I'll give you, I pulled up Apple's investor relations because Apple has done stock splits before, and we can go more into it. They did a 4-for-1 in 2020. They did a 7-for-1 in 2014, a 2-for-1 in 2005. They love doing this. So if I go to Apple stock now, right? Just not the split, just Apple stock. Okay, oh great. What's going on with the VPN now? Now I have to see where are all the mountains and hills. Let's hope I'm choosing the right thing. All right, so Apple stock today is at 142.87. Thanks for laughing at my dry jokes, Michelle. 142.87. So if I own one share in Apple right now, let's make it 142. Okay, it's $142. If they have a stock split today, what happens is, in fact, let's make the math even easier. Let's say the stock is trading at 140, just so that we can do a really round number, 140. So I have 1 stock at $140. What will happen when the stock splits 2-for-1 is that I will have 2 stocks for $70 each. So I will still have the same dollar amount of my holding in Apple, but I will have more shares that represent my holding in Apple. All right. So I repeat, I start out with one share at $140, and they have a 2-for-1 split, meaning you get 2 shares for every 1 share that you own. So now I'm thinking, oh, great, this is like, if you celebrate Christmas or Hanukkah or whatever came early, so I'm gonna get free shares. No, I'm not getting free shares. I'm moving from 1 share of 140 to 2 shares of $70 each. That still add up to 140. Shafak, oh, you're here. I was calling your name earlier. Do you have a question for me?
Yeah, I'm sorry. I'm at work, so I'm not always able to respond. But yeah, so I wanted to ask, what happens to the price of the stock when it splits? Like for example, you said it splits for 70.
It decreases. Yeah, it decreases.
So it
So if
goes
they
down to 70?
yeah, and if they had to, so it goes down to 70. So that feels like weird, right? Like, why would you do something that would cause your stock price to go down like that? Am I following your train of thought, Shafak? That it's a little bit strange that the price goes down, that they would do something like that? What?
Yeah, that's what I thought. Because I've heard about it, but I've never really experienced it. So I always wanted to know how does it exactly work?
Yeah, so basically what happens here is, like I said, and maybe I'll just type it out because I guess this is just the way I learn. I can't just talk into. So let's just say that the Apple stock, right, is trading at $140 per share, right? Let's also assume that each share has a $1 par value. That's not true, but I'm making that part up. Okay, $1 par value, and that there are 1 million. Also not true. I'm just making the numbers easy. Shares outstanding. So everybody has the fact pattern. Okay, the stock is trading around, and I'll go into the whys and all of the like, how is this even reasonable? Why would you do this? I'll go into it in a minute. I just want to walk you through all the impact of this, and then we'll talk about why we would do this, because you're asking good questions, Shafak. So Apple is trading at $140 per share. Assume that the shares each have a $1 par value and that there are 1 million shares outstanding. Apple announces, and I'm just doing 2-for-1. The same rules apply regardless of, you can do 7-for-1, you can do 10-for-1, whatever. Announces a 2-for-1 stock split. What is the impact, right, on the stock price, on the par value, and on the number of shares outstanding? And you saw there on Apple's investor relations that they've done this a number of times. So they obviously think that this is, the way to go. So first, the stock price. And here's your point, Shafak, right? The stock price, it goes from 140 per share to 70. And so it's 140 over 2, because it's 2-for-1, right? 140 divided by 2. So the stock price drops. I'm going to talk in a minute about why you would do something that would cause your stock price to drop. But that's the impact. The stock price drops. So if I had 1 share for 140 and I have 2 shares at $70 each, I still have to add back up to 140. The second piece is what happens to the par value. So the par value actually, because we are going to have more shares issued, the par value goes from $1 per share, you can already guess this, to 50 cents, right? So it's going to be $1 over 2, because for each stock that you had, Now, for each one stock that you had, you now have two. So you have to still end up at the same dollar amount for common stock. You can't create common stock by doing a stock split. So because we still have to because we still have to end up at the same dollar amount, and common stock is always the number of shares times the par value, your par value has to go down. I'll show you in a minute here. Again, if people are still a little bit confused, I'll show you how that works mathematically. So that's the par value, and then the number of shares, you can already kind of guess where we're going with this, goes from 1 million. Now remember, we split it 2 for 1, so it's going to go from 1 million to 2 million, okay? Because we're saying for every 1 share outstanding, there are now 2, because it's 2 for 1 split. So if you think about common stock, right? If you think about the common stock account, if you do before and after, we're just talking, okay? So don't panic that this is not like a formal example, before and after. Before it was 1 million, 1 million times $1 par value is $1 million. After, it's going to be 2 million. Is that enough zeros? Yes. Times 50 cents. Still the same, $1 million. And so that's what I mean. You can't just create more common stock dollars by having a stock split. Everything stays the same. The stock price goes down, but if someone is an investor in the company, their holding in the company doesn't change, just the number of shares that they have will change. So if I held 1 share for 140, I now have 2 shares at $70 each, which is still 140. So Shafak's question now is, why would a company do this, right? Why do this? Any ideas?
To make it affordable for everyone.
Yeah. Make the shares more, what they call marketable, which is the same as what you just said, affordable for everyone. So in the end, what ends up happening, the weird thing is, right, they do this, let me go back here to the FAQs for Apple. They did it on August the 28th. They did a 4 for 1. So let's see if we can find, when was that? Like a year, more than a year ago, really. Let me go 5 years. August the 28th, 2020. There. The stock price was 124, right? At the time of the split. They did the split. Let me see, or was it? I can't tell if this was, did I read the date right? August the 28th, 2020. Yeah. Doesn't even look like the stock price changed that much, but that doesn't make sense. The stock price did go down, but seemingly not by much. I don't know. I have to investigate, because the last time when they did the 7 for 1 split, the stock price went down pretty drastically, and then it came back up. Okay, so I'll have to look into exactly where the split was priced into the stock price. But theoretically, if it was around $120 that they, when they split it 4 for 1, then there would be a dip in the stock price, but then it comes back up. So to Shafak's point, they're trying to make the stock price more affordable. I know it's more obvious for the 7 for 1 split, which was in 2014. I mean, the stock price literally went down so drastically, but then, over time, if you had invested as soon as the stock price was split, you could end up like doubling your money in a year or two. So I think I'm not sure exactly why I think maybe the market already priced in the fact that the stock price would go up a little bit, but or the date in investor relations is wrong, because you can see there's a much bigger dip in the price over here and then it starts to climb. I'd have to look at it a little bit more, the dangers of speaking off the cuff in class. But to Shafak's point, and I see your hand, Shafak, we're splitting the stock so that more people are able to buy it, so that the stock price will actually increase again over time. You have a question, Shafak?
Yeah, I also wanted to know, I'm not sure if you said that already, but when they split the stock, do they do it on the basis of the buying price, like for the cost I bought, or for the market value? Like if I bought it for 120, so would it be based on like done based on $120, or would it be the market price?
No, it's based on the number of shares that you own, regardless of the price. And like the split is based on actual number of shares. So if I'm getting 2 for 1, right? So if I own 20,000 shares, now I will have 40,000 shares. The price that is being used is the market price on the date of the split.
Okay.
I hope I'm understanding your question and answering it.
Yeah.
Okay. Yeah. So the market price does factor in the sense that the market price should drop, which is why I was saying I was a little bit confused about why. I know for the previous split in 2014, I know that the price dropped, and when they split it, and then it started to climb again, but basically, you're looking at the market price and you're also looking at the number of shares. You have to, because people are getting more shares based on the shares that they already own. And so, I mean, okay, so, there's a little bit of confusion here, maybe in our minds about the 124, or maybe just in my mind, on the 124 on August the 28th. But you can see that post split, the Apple stock price is still just going up. I mean, they're obviously this company is attractive. They've got a $2 trillion market cap, which is the number of shares outstanding times the market price of the share. So definitely people are investing, and the stock split. And I was in chapter 13 for different reasons during the break, but to just go into I got kicked out of Wiley, but everything is happening here, right? But to just pick up on why the stock split, we want to make the shares more affordable for people. We want people to invest, and you're kind of playing the long game, because in the short term, your stock price could be dropping, but in the long term, your stock price just keeps climbing. But that's also why, even though Apple is like part of the FANG stocks, the Facebook, Apple, Alphabet, Netflix. Am I saying this right? Facebook, Apple, Alphabet, Netflix. Google is Alphabet, but I don't know if I'm missing a company. But the FANG stocks are basically the stocks that everybody's kind of like all excited about. They're in there, but if you look at what Apple's trading at, they're at 142 versus, it's Amazon. That's the other A that I'm looking for. It's Facebook, Apple, Amazon, Netflix, Google. They are nowhere near the price of some of these other stocks. Remember, we were looking at Google was like almost $3,000 a share. It's just not really affordable for people to invest in it. Yet Apple has a market cap of 2.36 trillion. That's what the company is worth. If you had to buy all the shares that were available, not that you could, but if you had to buy all the shares, you would have to pay 2.36 trillion. Whereas if you look at Google stock, for instance, and I mean, there's other factors that go into this, but I just want to show you that Google is only at 1.83 trillion, even though their stock price, is way higher than Apple. So we could think of stock splits as being like something weird, and why would you ever do that? You're causing your stock price to fall. But because Apple has increased the number of shares in circulation over time because of all these many splits, and again, there's multiple splits that happened over time, they've increased the number of shares. The share price inevitably rises after the split. So they actually end up in a position where the company is valued at not lower because of the split, but actually ends up being valued quite higher. So it is to their benefit. And then one share, just for jokes, I'll show you the share, which, let me ask, does anybody want to guess, like, what is the stock that has one of the highest prices, like, just in general, just as one of the highest prices, like, ever, or whatever?
Amazon?
Okay, so Amazon is high. Anybody else?
Tesla?
Okay, Tesla is high, yeah. But I mean, let's look at Tesla and Amazon.
Bitcoin?
So Tesla, okay, 808. So Bitcoin's crypto, but yeah, Bitcoin has gone over 50,000 recently. So that's also very high. Thank you, Maria. So 808 for Tesla. Sorry, guys. 808 for Tesla. Amazon is pretty wild price wise also. 3,200. Where's Bitcoin? Is 56,000, pretty high. So one of the highest though is, you may know this company, Berkshire Hathaway. It's the company that of which Warren Buffett is the CEO. Great, you bought Tesla for 700, so that means you're already 100 up. So Warren Buffett is the CEO. Warren Buffett is like, they call him the Oracle of Omaha. He's a very well-renowned investor. This is his company stock, $422,000 for one share. Just a bunch of change that you might have lying around. He does not want to split the stock. He never has split it. He said he's not interested in splitting it. So, it takes certainly a certain type of investor to be able to make a significant investment in this company, because, you can buy a small studio apartment or something with the price of one share. You're asking why doesn't he want to? So weirdly, like, he's not like super snobbish or anything. He's actually like, I've actually been in a room with him at LaGuardia. He's actually pretty like middle of the road, gives a lot of sound investment advice, but it seems that he's just not a fan of stock splits. He said, if people want to invest in his company, then they should be able to invest in it at the price that the stock is going. It's not his business he's not in the business of trying to make his shares, I guess, more marketable, so that everybody can invest. I think he doesn't feel the need to have, everybody invested. And by everybody, I just mean like people can afford it more if he splits the stock. He doesn't see the need for that. The guy's a billionaire. The company is a, almost $250 billion company. I mean, it was founded in the 1800s. So they're operating on a different mindset than, I guess, like an Apple that is just like, well, this is the way that we think we will keep growing the stock price. Is to split the stock from time to time and attract new investors and have more action in the stock. You can see that, this company is not going to have like a ton of, they're not going to have like tons and tons of activity in terms of, if you had to look at like how many transactions, sales of the stock, it's not as busy. And look at this, right? So their market cap is 634 billion. And I mean, you can't really compare apples to apples, but I mean, just think about it. Apple is at I didn't mean to say apples, not the Apple company. I just meant an actual apples to apples. But you can't really compare it because Apple is at, 2.3 trillion. These guys are still in the billions market cap wise. And if they did split their stocks, they'd have a higher market cap, but I don't think they can. That's probably the best way to say it. So yeah, so I agree with you. See, he's pretty down to earth. I don't think this has anything to do with necessarily his way of being in the world. It's just that he's not into maybe something that could be considered a little bit gimmicky in terms of trying to increase the stock price by splitting the stock is the bottom line. Yeah, so that's Apple. They I think there are a few articles, we won't go into it, but there are a few articles on after they split the stock, especially the stock split that happened earlier, like in 2014 or something, how much the price went up after that. The price almost doubled, and so it was good times for everybody because you have more shares and the share price is going up, so your investment is increasing. All right, so any other questions? This is kind of the bottom line with the stock split. Stock price decreases depending on the ratio, 2-for-1, 3-for-1, 7-for-1. It could be anything. You follow the same approach. Okay, if it was 7-for-1, I'd say 140 divided by 7, right? And it would be $20 per share. This would also be divided by 7, and so on. The par value goes down, the stock price goes down, the number of shares goes up. And all the dollar amounts in the balance sheet stay the same. Okay, the common stock balance stays the same. You can't create equity on the balance sheet just by increasing the number of shares that you're giving to people without actually, receiving anything in return. All right. So that's the deal with stock splits. And you'll see in the textbook, which I've now been, I think, timed out of, but you'll see in the textbook, it's not even, it's maybe like a page or half a page. It's not a big ticket item. It's not a big topic. And yeah, so I discuss how the par value changes. The purpose of the stock split is to increase the marketability of the stock. Doesn't require any journal entries because it doesn't have any effect on stockholders' equity amounts. Remember, I showed you the common stock balance stays the same. So there's no journal entries. You just have to disclose, like write in the financials that there was a stock split and that the par value went down and that the number of shares went up. That's it. Okay, that's why we haven't done a journal entry. I'm sure not that anybody's looking for journal entries to do, but there is nothing with the stock split. So how does that appear in a test and stuff? I mean, I know that's what you guys care about. Like, is this on the test? Probably more like a multiple choice question, saying that this company had a stock split. This was the par value before the split. This was the market price. And then different scenarios of, what is the new market price? What is the new par value? How many shares are outstanding? Okay, so you just need to be able to think through it. So remember, market price goes down, par value goes down, number of shares goes up. All right. Retained earnings. I know we're almost out of time. I'll just talk through what's happening in this next section. We've really only got 2 sections left on this chapter. And if I'm looking at, just bear with me, if I'm looking at the schedule here, we're slated to continue with this chapter until the 21st, but we'll probably be done by the 19th. So again, we'll figure out about people asking about reviewing and stuff. So we've got retained earnings, which we'll spend some time on, and then we've also got some work on the income statement and some analysis of the income statement, profit margin, and so on. So retained earnings, we've already said like a few times, it's the net income or loss. Remember, there's also possibility of a loss that the company is keeping in the business and it's not being distributed. So obviously a loss isn't going to be distributed as a dividend. So we'll just assume that we're working, with income. And so, let me actually just go into the text because I want to show you something that is useful when you're thinking about retained earnings. And I think I'll be able to open it up here, because I'm re-entering the textbook. Okay. All right, so retained earnings, we already said that, you know, it belongs to the stockholders. It's the earned capital that the company is earning, and that they have some claim over, but it's not related to a specific asset. And it certainly is, you know, you can't trace retained earnings back to cash. Sometimes companies have retained earnings because they've been profitable, but they don't actually have cash, you know, to show for it because they haven't maybe collected the cash from the customers. So you know, you always, like, if someone says to you, oh, I want you to invest in my business or whatever, I'm so profitable, you always have to ask them, but do you actually have cash on hand, like to pay your bills and stuff? Because it sometimes happens that, you know, look at this Facebook, this, I don't know what year this was, probably a few years back, but you're talking about 55 billion in retained earnings, but only 19 billion in cash and so on, right? Starbucks in this year, again, they're not telling us which year they're showing, but in that year, a 5.7 billion deficit, but they had 2.6 billion in cash. So you can't assume that retained earnings equals cash. That's not the answer. Retained earnings, again, is just, it's kind of a rolling balance of all the profit or loss, in the case of Starbucks, that was kept back in the company and, you know, hasn't been distributed. And it's, you know, it's part of stockholders' equity. What I wanted to show you was this illustration 1413 in the book is pretty helpful. It provides like a T account view of retained earnings and what increases and decreases it. I mean, I think they would have done well to also have a debits, you know, written debit and credit or up and down or whatever. But you guys know already, retained earnings is a stockholders equity account. It's a capital account. So it goes down on the debit side and up on the credit side, right? That's just the rule. So what they're showing us here is, you know, the possibility of all the things that could decrease retained earnings and all the things that could increase retained earnings. And so I'm showing this, you know, before we go deep into the weeds of you know, the retained earnings statement and so on, just to give people an overview of what we will be dealing with. So obviously a loss, if there's a loss, it's kind of eating into your retained earnings. So a loss will decrease retained earnings and net income will increase retained earnings, all right? What we're going to run into in this chapter is a notion of prior period or prior year adjustments. So what that means, and you know, it's a little bit of a tricky concept, so you have to make sure that you kind of hold on and understand it, is it's possible that in previous years, the company could have made mistakes in calculations for, let's say, expense accounts or other accounts, and they find out about the mistake, you know, in the current year. But if you think back on how the accounts work, remember that all the temporary accounts get closed off, the revenue and expense temporary accounts get closed off to income summary. And then income summary gets, this was like the first thing we did in chapter 13, right? And then you transfer net income from income summary to retained earnings. So if I find, for example, a mistake in 2021 related to depreciation expense, or related to salary expense or any type of expense, I can't in this year make the adjustment in the expense account because all the expense balances from 2020, from the previous year, have already been closed off to retained earnings. So all my prior period adjustments, if there was a mistake in revenue or expense, everything that went to net income, I will have to make the adjustment against retained earnings. And this is a part of the work where people sometimes get a little bit stuck because you kind of have to think about, you know, there was an error that was made previously, and now we need to fix the error. We can't go back into the revenue expense account from last year to fix it. We also don't want to fix it in this year's revenue expense account because it doesn't relate to this year. So the account we should use is retained earnings, and we need to figure out if that error, right, made retained earnings too big or too small last year, and then we have to decide what we will do about it this year. So it sounds kind of involved. It is. It's always like this with with corrections. Like, I mean, think about it in life, right? If you mess up something in your personal life, something to do with your bank account or whatever, when you make a mistake, you always have to figure out what was the mistake that I made. Then you have to figure out what should I have done. And then you got to figure out the difference, right? How do I fix this? What do I need to do to fix this? And it's the same in accounting. If we find a mistake or we think we found a mistake, we're asking, what was the mistake? What should have happened, which tells you, what's the impact of the mistake, and then what do we need to do to fix it? And so because it's a little bit of an involved process, thinking through about 3 steps, sometimes people get stuck on prior period adjustments. So if there was a prior period adjustment that caused net income to be too high, then when we fix it, we have to decrease retained earnings, because retained earnings and net income move in the same direction. The higher net income, the higher the retained earnings. The lower the net income, the lower the retained earnings. So if net income was too high from a previous year, it means retained earnings was too high. So we have to lower the retained earnings number on the debit side. If net income was too low, it means retained earnings was too low in the previous period. So we need to increase retained earnings on the credit side. If you already feel like your head is spinning, which is totally reasonable, I understand, but I'm showing you that, this prior period adjustment thing is not something that you're just going to be like, oh yeah, that makes total sense. You really need to think about it and read over it a few times. And I'll go over it deeper on Thursday. And then the other things that decrease retained earnings is cash and stock dividends, right? Cash and stock dividends, we just dealt with that. Remember, I told you that the cash dividend and the stock dividend account closes out to retained earnings, and it's a decrease in retained earnings because a dividend is a distribution of retained earnings. So it is going to lower your retained earnings. And then you don't really have to worry about the disposal of treasury stock that decreases retained earnings. That's for a treasury stock sale that's way below cost, that's outside of the scope of our work. So just be concerned up to number 3 and 1 and 2 on this side. So I'll end it there before there's an uprising here, because it's too much to take in, right? And I'll say that next time on Thursday we'll start here. Maybe just prime yourself a little bit about these prior period adjustments. The example that we'll start doing is, or the examples plural that we'll be doing have prior period adjustments in them. There's also examples of that in the book. It's basically the same example, so that by the time you get to me, you've maybe seen this once before. I'll do it. You can ask questions and hopefully be more comfortable. Again, the prior period adjustment piece is probably the hardest part of the retained earnings calculation. So please make sure that you spend some time looking at that. All right. So that's about it for now. I'll hang on until 12:45 if anybody has questions. Final reminder, the chapter 13 homework is due today. Please make sure that you are on it. It closes at 6 p.m. Do not email me at 4 o'clock or 5 o'clock to say, oops, I need more time. The answer will be what it's been up to now, which is that there are no time extensions, because these things have been available for ages. All right. And a lot of people, despite their very busy schedules, are managing to finish the homework on time. So please get on it. I also have office hours at 1 o'clock if anybody needs to see me for that. Okay, so I'll stop recording.